Today I'm back with another video on supply and demand. Now that we understand the foundation of supply and demand zones, there is one more critical concept we need to consider before entering a trade, and that is the liquidity sweep. A liquidity sweep is a move often used by large institutions to trap retail traders and fill their own limit orders at better prices. When we combine liquidity concepts with critical levels like supply and demand zones, and we pay attention to where liquidity is sitting around our critical zones or levels, we can significantly improve our winning rate and find better risk to reward opportunities. Liquidity on its own is not enough though. But when it's used together with strong confluences at critical levels or zones, it can help you take high probability trades. And today I'm gonna exactly cover the key concepts of liquidity in this video and show you how we can use them effectively in our trading. Before we dive deeper into liquidity concepts, I want to explain how liquidity should be used as an additional confluences for your entry criteria. You cannot trade based on liquidity alone just because you see it on chart. You need to understand the context first. So we start with market structure. We identify the trend. Is the market bullish or bearish? Next, we look for our point of interest. It can be supply and demand zones, it can be support and resistance, it can be last swing high or lows, or order blocks, uh, areas where institutional orders are entering the market. Then we look for liquidity, where resting pools of orders are sitting and where smart money and large institutions may step in. Liquidity should act as an extra confirmation to refine your entry, not as a standalone reason to take a trade. Okay, now let's talk about how to identify liquidity pools. These are areas on the chart where large amount of resting liquidity exists for big players to fill their positions. Liquidity is made of cluster of stop losses, pending limit orders, and breakout entries around obvious price levels. Liquidity is typically found around a structure high and lows, especially at key points like session high or lows, equal high or lows, trend lines, and support or resistance zones. These levels often act as liquidity magnets because it attracts a price. Above highs, we expect buy side liquidity, and below lows, we expect sell side liquidity. In general, any clear patterns in the market which encourages traders to place orders at predictable levels, creating liquidity pools that larger players and big institutionals can use efficiently. And now let's see what the liquidity looks like on a chart. We have a fresh supply zone. We see a breakout of a zone where price push above a little bit of the zone to trigger stop losses and then close back down the supply zone. This is liquidity sweep. This means that smart money has absorbed the liquidity above this supply zone and now it's ready to push the price lower. Once you see the liquidity sweep, don't just jump into the trade blindly. You have to wait for price action confirmation. When a liquidity sweep happens, it leaves a footprint in the form of specific candlestick patterns. We need to look for a pin bar, a small body, and long wick, or doji candles. What a pin bar actually signal to us, it says the market attempted to move in one direction but was quickly rejected by strong forces in the opposite direction. This rejection by this pin bar tells us the initial move was likely false and the price is most likely go into the opposite direction. When a bearish bar forms at the supply zone, like this pin bar here, is an important signal. This is our confirmation that smart money is interested in this zone, making it a great opportunity for us to enter a sell or short trade. And as you can see here, it gives us a very perfect a sniper entry and with a very good risk to reward ratio. Let's look at the another liquidity sweep signal, the tail bar. A doji is a type of tail bar. A tail bar has a small body and a long wick just on one side, and the other side is a lower wick. The wick shows where price was strongly rejected. In this case, sellers step in and push price down from higher levels. If the candle closes inside or below the supply zone, it signals that the zone is being respected by smart money. The longer upper wick also tells us that buying pressure has been absorbed and price may move lower. This pattern acts as confirmation after liquidity sweep. Once it forms, you can look for a sell trade or short, place your stop loss above the tail bar, and target the next support level, which can be the last low or obvious equal lows. And in this case, as you can see, it even went lower than our first take profit, and it's good always have runners after your first take profit so you can catch a bigger momentum. Okay, now let's talk about a supply and demand zone that has a clear support or resistance level in front of it. Many traders expect price to bounce from these levels, but smart money sees them as a liquidity trap, not entry points. Below support, there is sell side liquidity, stop losses from buyers, and sell orders from breakout traders. This is called a stop loss liquidity, and it's what smart money uses to enter or exit large position. They often push price into these areas to trigger stops and then reverse the market. So here's how it looks like on a chart. First, we have here our demand zone on 1 hour in a higher time frame. We mark the origin. Um, then we notice a support level forming just after the zone. And as you can see here, first touch, here second touch, third touch, and fourth touch. The more times price touches these levels, the more traders notice it and the more liquidity builds below it. Once price breaks below support, as you can see here, and also it touches our 200 moving average and quickly closes back above it, that's a liquidity sweep. If price reacts strongly and moves away from the zone with momentum, as you can see with this engulfing candle, that's our signal to enter a trade. From there, you can target a fixed risk reward ratio or aim for the next resistance level. For example, here, our last protected high. Other major forms of liquidity comes from trend lines. In an uptrend, once a bullish trend line has at least two touches, many traders expect the next touch to hold. They start buying each retest and place their stop losses just below the trend line. This creates a pool of liquidity underneath it. At the same time, breakout traders are ready to sell if the trend line breaks. But instead of clean bounce or a simple break and retest, the market often dips below the trend line first. This move sweeps the liquidity, triggers stop losses both from buyer side and seller side, and then price reverse back up. As a result, both buyers and sellers get stopped out while big players enter in the opposite direction. You can apply the same concept to bearish or descending trend lines as well, just in reverse. As you can see here, those breakout traders, after they saw a candle close blue at the trend line, they enter, but the market stopped them out, as you can see. Or the people or the buyers or the traders that buy at the third touch, they get stopped out because it went lower than the trend line. And then after the liquidity sweep, after this narrow consolidation here, smart money liquid both buyers and sellers, retailers, and then deep down to the strong momentum down. So that's it for today's video, guys. Hope you found it helpful. Please stay tuned for more trading content coming every week.